everyone. I'm Rachel Warren. I'm your host, and we're going to get started in a few minutes. Please pop in our chat and let us know where you're from. We'd love to hear from you. We got something truly exciting in store for you. We know that childcare businesses are at the heart of creating nurturing and educational environments for our youngest learners. But have you ever wondered if you're missing out on financial opportunities or could help elevate your childcare game to a whole new level? Well, wonder no longer, because we are about to dive deep into the world of childcare business finance like we've never done before. And join us to reveal the top financial secrets for childcare businesses that you may not be taking advantage of. And it's time to level up your financial game and discover the hidden treasures that can make a world of difference. To guide us through this thrilling adventure, we have a special guest, Nate Pensgen. With his expertise and his insights, you are in for a treat, and we will uncover valuable insights, tips, and tricks to just supercharge your childcare business financial success. Butch, who has asked us, yes, you can get the recording sent to you afterwards if you have to drop off. Thank you so much for putting that in our chat box. We definitely love to hear where everybody's from. So please don't feel afraid and let us know. Oh, look, it's Sonia Thomas. Hi, Sonia. Sonia's from Portland, Oregon. Thanks for joining us. We got Jessica Martinez from Texas and Lisa from Des Plaines, Illinois. Welcome. We have Zeta from Texas. Great to see everybody. Oh, we have Cami from New Mexico. So we have people from all over. We have Darcy from Boston, Massachusetts. We have Nip from New Hampshire. We have Vandana from Texas. Welcome. And our very own Kimberly Bennett. Hello. I am Rachel Warren, and I am your member advocate with Inspire Care 360. And I am absolutely thrilled to be your host for this upcoming webinar. So get ready for a fun-filled and enlightening session. Any comments that you have, please put them in the chat box. Sarah will be posting links throughout the webinar. We will have some of our, these are some of our agendas. So we'll have some housekeeping, the introduction, some discussion, and a little bit about IC 360. If you're looking for any type of certificate for the webinar, then you can just follow the link and you will receive a certificate. Be on the lookout for Sarah to post that in the chat box so you can get credit for that. And to get ready to unlock this treasure chest of financial wisdom, we have our founder and CEO, Tony D'Agostino, who is going to be presenting this, and his passion in childcare for excellence and business wisdom. Tony is going to set the stage for such an engaging, informative experience that you're not going to want to miss it. So get ready and welcome, Tony.
Well, thank you, Rachel. Thank you for the kind words and really setting the stage as our MC today. I really appreciate it. Welcome to your first one as being an MC too. That's awesome.
Thank you.
Awesome. Well, thank you so much. I'll take over from here, Rachel, and Rachel will be in the background, so you will see her in the chat and the Q&A. So thank you, Rachel. You're welcome to go off video if you want. It's up to you. But we're going to go ahead and get started. Folks, just to do a little housekeeping here, Please use the chat if you're looking to communicate with one another or communicate with Sarah or Rachel. Use the Q&A if you would like to ask us a question. So whether you're asking me a question or you're asking Nate a question, please do not hesitate. This is being recorded. We are recording this as we do with all of ours, and it will be put onto our website for replay, as well as all the registrants will get a link to the replay on this. There will be some solid information in here, and we will have the deck available for those who are interested in seeing and walking through that deck information. So let's go and get started overall. First thing we're going to do is a little bit of housekeeping. And I want to talk to you a little bit about one of our solutions we haven't talked about in a little while. And this is IC360 Rep. IC360 Rep is a very super cool star rating tool. It is an all-in-one platform that you can have as a member, or it is one of the few options that we have as a non-member. And this program is a great program for driving up your star ratings. A lot of times people have a star rating where they have 2 or 3 good star ratings. And unfortunately, then one day what happens is they get a disgruntled former employee or a disgruntled family who came through and give them a 1 star and take that wonderful 5-star rating down to like 1 star. Or they may have struggled with some turnover, and in turn, it has hit you on your star ratings, whether it be on Google, Yelp, Facebook, Angie's List, any of the places, care.com, great schools. So this is an all-in-one platform. It is where you can both create a request to your staff, to your families, to people who interview at your schools, and people who tour at your schools. It is all done online. So people can do it on a laptop or a phone if they get it requested. There's also over to the right-hand side here a QR code. So they can actually shoot this QR code at your front desk, right where you have a kiosk where they might be signing in. Very simple to use. It is integrated, so it does work with many of the different environments that we just talked about for star rating. You also get real-time monitoring. So not only do you get to know if a star rating came through that you requested, but if one that you did not request comes through, where someone just went up to your review one of the review sites and did a review on you, you would get a request or basically a notification that came in, because we also believe that you can respond with that. You have a lot of information on the kind of trends and the information that is given, and it really helps establish your credibility. It's very efficient overall, and it also manages those reviews for your SEO or your search engine optimization. I'm going to just take one moment to actually have you take a quick look of what it actually looks like online. So what I'd like to do is, let me see if I can just move this for 1 second here and get rid of that and go back to here to share. And what we're going to do is I'm going to show you here. This is actually where the tool is. Now I have one for Inspire Care 360, but I'll put it in for one of my childcare schools because I don't want to bring up all of our other members and what have you that are in here. But I'll bring you one in here. And this just shows you exactly what the platform looks like, what you would have and you would be able to see. So in this environment, this is where you'll be requesting star ratings. And this simply goes out to the names that you put in it. The challenge is you cannot put star rating requests out in mass to your families or to your staff or to others, because Google as well as Facebook, they have the analytics that they'll block that. But what this does is it uses and works with the analytics of Google and Facebook and care.com and all them, and it allows them to funnel the right amount of requests out. And then what happens is if you get a good or a great star rating, it goes right to that site where they're able to put up their star rating directly into that environment. If you get an okay, a subpar, or bad, that comes back to leadership. It comes back to you, and you have an opportunity to work on it. And I'll give you an example here. So, for instance, when we've used it for our own schools, you'll see these different star ratings that we have here. So, a lot of 5-star reviews, but we did have a poor star rating. and this was back in September. We found out that there was an issue that a family had. It came down to a family who had an issue with how one of the children in that classroom was being addressed. And she immediately went on here, and this is what she did: is she gave us a negative review. That you would say is, oh, that's horrible. Well, the thing is, it came to us. That gave my team and myself the real opportunity to reach out to that family member and then discuss what is the issues that was driving her there. We were then able to get that latent issue and repair it, and then come back and ask her to come back and re-review. But there's an opportunity to respond to any of these reviews directly in here. You can share these reviews onto multiple sites, and you can provide different edits. There's all kinds of reporting, but it's like we just showed you too. You have the opportunity to even create QR codes and print out those QR codes or download those images to put it on your website or to put it right next to a kiosk. So enough of that. I'm going to go back to our presentation, and I wanted just to take a moment to show you what we had going on with IC360 Rep. So we're going to continue on here and just do a next slide here, which is about Healthy Advantage. I think a lot of you have heard about it, but if you haven't, a lot of benefit enrollments is going on right now. This is a great program for your staff, highly flexible, highly affordable. We just started looking at rates again for major medical programs because this program can work with your existing major medical programs. Because a few people have a major medical doesn't mean you cannot offer this to all of your staff or all the others. And it also meets the Affordable Care Act requirements for Part A of the Affordable Care Act. But it's a great program that offers flexibility for the number of different type of programs, where for the ultimate program, which they now call Elite Care, that's $130 a month for an employee, and they give them $15 office visits, $15 specialist visits. Fantastic. We do all of the benefit support in really helping out that this gets rolled out. And then there's voluntary and supplemental plans, as you can see. So highly affordable, highly flexible, easily to implement. If you are interested in this program or IC360 Lab, shoot us in the chat or email us, but just say, hey, I'd love to learn more about that. And then we'll grab your name. Rachel will grab your name, and we will be sure to get you engaged and let you learn as much as you need. You do need about a month and a half for Healthy Advantage to get set up. IC360 Rep can be set up literally in a day. So just to let you know, and now what we're going to do is I'm going to ask to come on board is Nate Pensgen. And Nate, come on board. How are you doing today, bud?
Tony, how you doing?
I'm doing great. So Nate is a partner over at our IC360 Financial Experts. The Financial 360 Financial Experts has been our relationship that we have had with these gentlemen and these ladies over here at RDG and Partners. Matter of fact, John Rizzo, are you there?
Yeah, I'm here. Hey, Tony, how are you?
Great. John is the managing principal over there. He's been on many of our podcasts before. He's done all the PPP loan things, the ERC credits. So he has been a staple of our organization too. So we're glad to have Nate. Nate focuses more on the tax side. The reason we came up with this today, the reason we did this in November, or excuse me, in October, not even November yet, is because of end of the year planning. This is the time that you should be thinking about it. And so what Nate's going to be talking about are some ideas, some thoughts that you should have. His background really does go across the whole tax compliance, but as well as the consultancy side of the industry. He's had some great experience on the buy and sell side. So what that means, our financial experts not only are supportive with, tax and what have you in consulting, but the real areas that they can be super helpful for, and they've helped a number of our members, is really the expansion of their footprint, or when it's time to succeed out of their business, of getting them prepared for succession. I know they've worked with one of our members and memberships, at least, that they work with a private equity firm with them and help prepare them to do expansion working with a private equity firm. So they've done some fantastic work. So you could see Nate is originally from Western New York, and he does have all the certifications after his name. So Nate, I'm going to hand it off to you right now and allow you to take over the presentation. as to what we're going to talk about a little bit today.
Thanks, Tony. John and I are definitely happy to be here and happy to share some tips and tricks with all of you to help your financial plan as we near year end go as smoothly as possible. So again, our goal today is to provide each and every one of you with a sort of a toolkit of things that you can consider, tasks that you can prepare for as you near year end to make sure that your tax planning and your overall financial planning process goes smoothly. We want to emphasize one of the key points out of this whole presentation is, while tax planning is an important part of your financial planning process, it's definitely not the only thing. You should be engaging all of your advisors in a collaborative manner, whether that be your retirement advisors, your investment advisors, your estate and planning advisors, just to make sure that everyone's in the room as much as possible and as consistently as possible throughout the year, just to make sure that your overall financial plan goes smoothly. Tony, you can move to the next slide.
Okay.
Thanks. So the first step is just to make sure that your financial house is in order. And what we mean by that is your accounts should be reconciled on a monthly basis if possible. And that means, your bank statements, credit card statements, intercompany transactions, etc. And from there, once you have a good handle on that, the next step would be to take a step back and analyze your P&L, your balance sheet, to see if there's any variances or anything that seems out of whack. Good books are based on good policies and procedures, but in order for those policies and procedures to be effective, you have to follow them consistently. So that's why we recommend, reconciling your accounts on a monthly basis versus waiting to year end. But at a minimum, we recommend that your books are in good order by November 15th to help ensure that the tax planning and overall financial planning process goes as smoothly as possible.
Hey, Nate, a question for you. There's probably a number of people out there who do a really good job. They're really on top of. There's probably some other people out there who probably, maybe because the business is really foremost in their mind, that this may not be really top of mind. What are the kind of things that, if you haven't been able to reconcile things or really do that in a very proactive manner, do you have any thoughts on how to get ahead of it for the following year?
Yeah, I mean, one of the key things is we understand that all businesses don't have a robust, financial department within their daycare centers. So you could always enlist the services of a CPA or an outsourced CFO controller type, and they can get you up and running and into a good spot. And then, from there going forward, you can decide if it's worth, having them continue on. But I think at that point, at least they would set you up with a good benchmark moving forward.
Great, thank you.
Yeah, and so after you analyze your books and records and take a step back, the next step in the process is to review actual results and then layer on a budget or an estimate of where you think you're going to be for the remainder of the year. And that's going to give you a good snapshot on, where do we think we are from a financial perspective as we get to year end. And then once you have a good handle on that, we'd recommend providing that information to your CPAs or other financial advisors that you're using to help with your tax plan, and they can help put together, either a tax projection or a tax plan for you as we head into the fourth quarter. And then the last step is, we're always, looking backwards for things here, but really, as business owners, we should also be looking forward. And so I think it's critical to put together a good solid budget for the next year. But in order to do that, we got to make sure that our actual results for this year are in good order. And the reason why budgets are important is for funding. For instance, there's different state funding mechanisms out there in different states, so they're going to require you to provide them with a good solid budget and financial plan in order to maximize the amount of money that you could potentially get from them. And then also, it's a good idea for general planning purposes. If you're looking to sell your business, or buy another business, it's good to know where you stand at any given point in time.
So a question for you, Nate. If someone hasn't been putting together a budget, which, listen, I've been completely guilty of that myself on some years, for sure. But if someone did want to put together a budget, is it fair to do things like, if you have a general ledger, which is your P&L statement, basically, right? With your, what is the revenue that's coming in? What is the money that's going out? To simply put in there and look at, are you looking at, we should have a month by month budget going forward, or are you looking for something that it's an annual budget? What do you think is appropriate? And is there any quick tips or tricks as to how to make sure you just can put a budget together without burning too many calories?
Sure, that's a great question. I mean, ideally, we'd like to have budgets month by month. As part of your financial close process, it's good to look at your results, month over month. But if you can't do that, then the next step would be quarterly. Because I think, from a tax planning perspective and financial planning perspective, we would say that quarterly planning is the next step if you can't do monthly. If you do, and then year over year is also helpful just to get a more broad picture on where you stand. But ideally, monthly or quarterly would be great.
All right, fantastic.
All right. So, once you get your financial records in order, the next step in the process is to prepare a good tax plan. And the first step in that process, like we talked about a little bit on the previous slide, is to use your year-to-date results, your actual results, and then layer on an estimate for the remainder of the year. And that'll give you a good benchmark on where you stand. And most daycare centers that we work with are on the cash basis versus the accrual basis. And that's generally a better place to be at if you're on a cash basis, because it kind of aligns more with the cash flow of the business itself. And so it's easier to manage, where your earnings are. So for instance, if you're on the cash basis, you can manage where your accounts receivable or accounts payable are as you near your end. If you keep your receivables up and don't collect as much, and if you keep your payables down and pay as much as you can by year end, that's generally going to lower your financial income and lower the amount of taxes you're going to pay.
Okay, you mentioned something there that I think has been a strategy that I've taken on board for many years, and that is, when it comes close to the end of the year, I am trying to drive as many of my expenses in to my, accounting environment to get them paid out before the end of the year. But I'm also, if I'm receiving any checks in, whether it be for social service programs at my schools or whether it be for any other bigger checks that may be coming in, and even possibly, parent deposits at the very end of the year, I'm trying to drive them into the following year. Is there really a strategy behind that can be helpful? And, does that also have the temperature of the financial climate from, how, things are being run overall not only in the industry, but just the overall financial climate?
Yeah, that's another good question. I mean, I'd say overall, the goal of tax planning is to defer income wherever possible and accelerate expenses where you can. So by deferring or pushing out any receipts of income that you would have coming in, and then accelerating any of your payables, paying them before year end, that's the best strategy in terms of minimizing taxes.
What are the kind of things you typically can try to accelerate? I have a few ideas, but just wanted to ask you, what you think are a few that you can accelerate typically.
Yeah, you can accelerate, if you're considering paying bonuses, you could accelerate those. If you're considering doing improvements to your daycare center, if it's, putting on a new classroom or, putting in a new playground, if you can accelerate those into the tax year, then you can take those deductions in this year versus pushing it out a year. Retirement plan contributions are another good mechanism. So to the extent you can fund your retirement plan sooner than later, that's a great way to also reduce your tax liability.
Yeah, because typically a tax, when it comes to retirement plans, typically I think you have to April 15th, but if you could fund it in this year, it counts for this year. So I would assume similar like a playground equipment. Some people are like, yeah, I want to get a playground equipment in before the end of the year to take advantage of it. Well, it's good, but remember, it's what you pay. So if you get it installed, you don't get it invoiced to you until January. It's going to be getting pushed to the next year, correct?
Generally, that's right. I mean, taxes are generally based on when you pay for something. So it's based on cash, cash that you outlay. So that's, yeah, correct. That's generally right. You want to pay for stuff before year end rather than wait until after.
Yeah, and so one of the other areas, and I'll let you keep on going here, but that I've been doing, is anybody who sort of gets delayed, because we'll have like our CAMs for some of our lease properties, or we'll have some things where they tend to delay their invoicing. And it's just how they naturally go through the year. They're not invoicing at that time. I will either call them and ask them for an invoice, or in some situations, I will pay in advance with a credit towards that invoice that I know that's coming based on previous years. And that's really helped me, basically drive up my expenses so I don't have such an expense impact in January. So,
Yeah, exactly. Sometimes you have to manage your vendors to get the tax result and the financial result that you want.
all right, great. So keep on going.
Okay. So I think we've covered the first two columns there. So moving to the third column, after we've set up a nice tax projection, and we've considered ways to reduce our taxes, the final piece of that puzzle in order to provide an effective tax plan is to review the different scenarios we've come up with and determine what the appropriate course of action there is to implement them. So for instance, we talked about a little bit about retirement contributions. So in order to get those plan, if you're considering setting up a retirement plan, you want to do that sooner than later. It's not something that can happen, with the snap of a finger. You got to work with your payroll service providers and 401k providers well in advance to make sure that you're meeting all of the notice requirements set by the IRS and the government. So for instance, if you wanted to set up a retirement plan, you might have to work with your payroll and retirement 401k advisors and get that set up by like September 1st or October 1st at the latest to make sure that it's in place by the end of the year.
Yeah, a matter of fact, just thinking about that, for my schools that I had outside of Inspire Care 360, but because I, my being a founder of IC 360, it affects my staff there too. I had a simple IRA plan previously in place. And I know with my tax planning, with the financial experts that you see right here with RDG, they came to me with some really thoughtful recommendations, and they recommended a 401k safe harbor for me. So I was looking at the difference between the simple IRA and the 401k safe harbor. And at first, it looked a little intimidating because I was basically going to be upping my match substantially for staff. But then after I looked at all the benefits that it really brought to the table, it made a lot of sense for me to go with that 401k safe harbor, which also has become really attractive in recruiting and retaining my teammates because they also can give themselves a pay increase when they participate. And it also works to their longevity. So it worked out well for me. But the point of caution, which I'm just going to play off of what Nate just said, is it took me honestly about 3 months, maybe 4 months from soup to nuts to get the entire program done. So if you're looking to just implement that now, you likely won't get it done before the end of the year. It's something that might be able to happen, but a lot of things have to come together because you're interdependent. I guess you would say, Nate, on a few different organizations to come together.
Yeah, absolutely, that's absolutely right. And that kind of segues nicely into the next slide. Yeah, so a good tax plan and financial planning option is retirement, setting up a retirement plan. And as you can now see here, we've outlined a few different plans that you could put in place. And generally these go from the most simple, most easy to implement, and the cheapest, upwards from there. So for instance, the simple IRA is the cheapest and the simplest to put in place, but you can also contribute the least amount of money for both your employees and yourself. The next option is a 401k safe harbor, which Tony, you were just discussing. And in general, you can contribute more to that for both your employees and yourself. But it's a little bit harder to implement and administer, and it's a little bit more costly. But one of the advantage of that plan is you can kind of add on a cash balance plan or a defined benefit plan as you see a little bit further down there. And the defined benefit or the cash balance plan really allows you to contribute the most amount of money as a business owner to your retirement. And you can combine it with a 401k option to really sort of supercharge the amount of money you can contribute to your retirement. And the amount you contribute to retirement also results in significant tax deductions. So I'd say the sweet spot is probably the 401k safe harbor option. That's what we see a lot of our daycare centers utilizing. And like Tony mentioned, there are tax aspects to it. It does save in taxes. It does help your retirement, but it also is a great employee retention tool, and keeping employees at your organizations as long as you can. All right, so the next good option in terms of tax planning, we've sort of touched upon this, is fixed assets or capital expenditures. So if you put in place a new playground or a new classroom, there's certain rules in place that dictate how much you can expense in a given year. So you can't necessarily expense all of that, but you can expense a good chunk of it. And generally this is done through what's called bonus depreciation or accelerated depreciation. And that just is another name for how fast you can expense something, the capital expenditure that you're placing in the service. And so like bonus depreciation for 2023, you can write off or expense 80% of that asset that you placed in the service. And then you can depreciate or expense the remaining 20% over the useful life of that asset. The one thing to keep in mind with bonus is that bonus depreciation is phasing out over time. So by 2027, it's going to go away. There's not going to be an option to use bonus depreciation. So then the next option there is Section 179. And there's more limitations on that, I'd say, than bonus depreciation, but it's also another available option to utilize, sometimes utilize in conjunction with bonus depreciation. So you can kind of manage your tax brackets, you can manage your income through using Section 179, bring your income down to zero, and then you can utilize bonus depreciation on top of that, or in addition to it, to drive yourself into a taxable loss if that situation arises. So, both of these are key considerations to keep in mind if you're going to be placing in a service any sort of significant capital improvements.
Hey, Nate, is Section 179 applied where you have a vehicle that can have a load of 6,000 pounds or more that is used for the business that can be immediately depreciated to pretty much the full extent of it?
That is a consideration. So generally, the heavier the vehicle and the less likely it is to be used as like a passenger vehicle, the more likely you're going to be able to expense all of it. The less weight the vehicle is and the more it's kind of used as like a everyday driving type vehicle, then sometimes the depreciation can be limited.
Well, I do.
Yeah, you're right. You're right.
Go ahead, Nate.
No, you're right. You can buy a vehicle, use it in the business, and generally get accelerated depreciation on it.
Yeah, I have a friend who's a business owner who, bought a truck, had the whole vehicle wrapped with his company on it. So when he drives through town, you can see his company when that truck is coming, and it is something where he, I think, was probably able to take full advantage of the Section 179 here. So he had the ability to acquire a vehicle, which basically you probably could do before the end of the year here to, still as part of your tax planning. And, if you do need a vehicle for your overall business where you're going to be traveling between centers and, hey, you have to pick up stuff, pick up signs, pick up food, things of that nature. So.
Absolutely. Yeah. Just a couple other key points with capital improvements. So if you're looking to expand and you happen to buy a new practice, for instance, you can do what's called a cost segregation study. And what that does is it takes a look at the building itself. And you might think, well, it's just a building, it's all going to be depreciated over and expensed over the same life. But you can break that building down into different components like bathroom or roof, plumbing, HVAC systems, and all of those have different depreciable lives. A lot of them are shorter lived. And so that's where you can take something that would have been depreciated over a longer period of time and accelerate those deductions into a much shorter period of time. So a cost segregation study is something key to consider if you're either putting on a big renovation onto one of your existing daycare centers or are considering purchasing a new one in the future.
Fantastic. Is that obviously done at the point in time of acquisition, or is that something you should really be planning ahead with your professional?
Well, you always want to try to plan ahead as much as possible, just to make sure that you're expensing things in the year you want to expense them in. There is the possibility that you can place a building in service in 1 year, and then a year or two down the line say, oh, I want to do a cost segregation study on that building, and you can still do that. So you don't have to do the cost seg in the year necessarily that you buy the building, but it's generally gives you the best answer.
Okay, great.
Okay, next, okay. A couple other final considerations as part of your tax planning process is, one thing to consider is the qualifying business income deduction. And this came about as part of the Tax Cuts and Jobs Act under President Trump went in effect in 2018. So it's been out there for a few years, but it's something that you should definitely be taking advantage of if for whatever reason you're not. And basically it's a 20% deduction, tax deduction on what's called your qualifying business income, which is essentially the income of the taxable income of your business. And the key here is it's not based on any of the expenses you've already paid for from a book perspective. It's on top of that. So it's a permanent tax deduction on top of whatever you've already spent cash wise for the business. So it's definitely something it's a powerful tool out there. And the reason they put it in place really was to get, as a C Corp tax rate went down to 21%, the government wanted to encourage companies to continue using like S corporations and partnerships and other flow through entities.
What does UBIA stand for?
It's like the unadjusted basis of the property in your daycare center. So it's basically like all of the costs of your fixed assets, like the building, the facility cost. That's generally what that is. And
Okay.
it enters into the calculation of that deduction.
Great, thank you.
Yep. Then the final consideration is looking at rents and wages. So wages are important because, well, one, they need to be reasonable. They need to be based on job duties, experience, and what the market dictates. But also wages are an important factor in retirement contributions. In terms of rent, if you own the real estate that your daycare center is operating in, then you own that real estate in a separate entity, you can kind of work with the rent you're charging to your daycare center and hopefully drive down your operating company's income. Because by driving down your operating company, the daycare center facility's income, that generally gives you a better tax answer, because that income is generally subject to self-employment tax. And by driving that down, you're going to get a better tax answer.
Can you give sort of a scenario there so people can understand that maybe a little bit better?
Sure. So if you had a real estate company that maybe was operating at a loss, and you had a daycare center that was operating at a substantial amount of income, you might not be able to fully utilize that loss in that real estate entity. So you might want to consider bumping up the rents in it and drive up the income in there to as close to break even as possible, while driving down your daycare center's operating income.
So basically you can do like a sweetheart lease agreement to yourself, or between one entity and another, that would increase the rents. That would be a bigger expense for the childcare business, so they have a higher expense, but that takes down their taxable income, while it increases the revenue for your property management company if you manage under a separate LLC or the like, right?
Right, exactly. I mean, the rent should generally be market based,
Sure.
But there is a little bit of leeway there. But
You're
yeah,
learning how I think a little bit, Nate. So and John's over there wanting to chime in and go, Tony, please come down a little.
Yeah. I thought you liked paying taxes. I don't know, something changed.
Yeah, exactly.
just as we're talking about like real estate company versus daycare center operating company, another consideration is generally you want to set up a separate entity, an LLC, generally to own your real estate. You don't want to own your real estate in an S corp or a C corporation, because it can give you some bad tax answers if you ever try to get the real estate out of there or sell it. So what we recommend to our daycare centers is set up a separate LLC to house that real estate, and then set up a separate entity to operate the daycare center itself. It's the cleanest way to do it, and it gives the best tax answer as you're looking to plan for things down the road, like selling the business.
So Nate, Sonia had asked here, what if I own my building outright under our S corp? Can I pay rent to myself under my name? There need to be some additional detail on that question, but in
Yeah,
general, it sounds like that she owns it all together.
okay. Well, if it's all in the same entity, then generally it won't matter, what rent you're charging, because it's all going to be reported on the same tax return. But we might be able to get some more color on that, and I can follow up offline if needed.
Absolutely. And also you could look at possibly moving the property to an LLC possibly.
Right. Yeah, exactly. It is tougher to get out of an S corp once it's in there, but you can, ideally you'd want it in an LLC.
Okay.
So the final piece is like, when should you be doing tax planning after everything that we've talked about considered here? And like we've talked about, it should hopefully be done on a quarterly basis if you can. It's just easier to manage tax law changes. It's easier to manage all of your different financial advisors that should be a part of the process. Like we said, your tax advisors should be involved, your retirement advisors, investment advisors, estate and trust advisors if possible. So open communication is always the key here. And it should be collaborative and as often as you can.
If you, a lot of times is before we move on to the next slide here, but Nate, a lot of times we either work with a bookkeeper or an accountant or even a CPA who process our taxes at the end of the year. Yet they sometimes may not provide us with the exact kind of guidance that we need for either tax planning or specifically to like the childcare industry. Is it uncommon to bring in another consultant to start looking at planning from a consulting standpoint? Or should you just strictly work only with your CPA?
No, I mean, like I said, you should introduce as many advisors as you can. I mean, hopefully you're working with a firm or a advisory firm that has a lot of those advisors under one roof, and therefore it'll be a lot easier to keep the open lines of communication going.
Okay, great.
And so I just wanted to provide some don'ts, just things that stick out to us. So like we have kind of talked about throughout this presentation, don't wait until the last minute. You want to be as proactive as possible, take advantage of all the tax deductions you can. Don't forget to include non-tax considerations like retirement contributions, investment opportunities, estate planning. So there's everything that you're doing has tax consequences most likely, but it also has non-tax considerations that should be thought of as well. And then the last is don't neglect accurate books and records. Like we started off with, the first step in providing a nice tax plan and financial plan is to make sure your financial house is in order. So make sure your books and records are as accurate as possible, so that going forward, you have a good benchmark to work from.
So let me ask you about those three big buckets there. Don't wait until the last minute. What is the last minute? What is sort of, a good timing to think about before the end of the year? And then again, I know too, which I think it's worth talking about. We're talking about end of the year tax planning. However, quite often all your information about taxes going to a CPA or the like usually doesn't have to go out until, after January, after you've published all your W-2s, and all those things. So what are your thoughts when you talk about last minute on different areas?
Yeah, that's a good question. I would say, November 15th is probably the drop dead date that you want to get information to your advisors. We as a firm like to meet with our daycare centers and clients on a quarterly basis, just to make sure that we're not missing anything, that we're getting their information timely, and we're providing them with solid financial advice so that they can make decisions that are going to obviously impact their tax situation as well as their business operations. It helps us to be, I guess it helps us to be proactive advisors rather than reactive. The later we get information, or the later advisors get information, the more reactive they become versus proactive.
Okay, great. And then when you think about after the new year and really getting all your information to your tax advisors, I know you guys go through a lot of things, but typically it's March 15th that you have to be submitting business taxes by. Is that accurate?
Yep. Generally, if you own a flow through entity like a S Corp or partnership, those taxes are due March 15th, and then your individual returns are due April, unless you choose to extend.
Okay.
So we like to get our, if our clients can get us information in January, early February, that's great. That gets us a head start on making sure that we're being as proactive as we can.
So give us, if you could, more examples of when you say don't forget to include non-tax considerations. What are a few more examples for that?
Like estate planning. Like if you're getting older and you are trying to phase the business to your children, that's something that isn't going to happen overnight. It's going to take a period of time, and it's going to take the help of other financial advisors other than just your pure tax advisors. So that's a good consideration. If you're looking to buy a business or sell your business, that it's going to take some time and planning to put that all into place. So that's another example.
Yeah, I'd say another item there, Tony, is there's that saying that exists out there about don't let the tax tail
Wag the dog.
wag the profit dog, or wag the
Yeah.
investment dog, right? So we see too many times that, hey, I'm considering selling my business over the next few years. So those are the years you want to show more profits, and buyers put more value in tax return reported numbers than anything else, because their assumption is, well, if you're going to show the government you have gobs of profit, then it must be real.
Mm-hmm.
So saving taxes isn't always the right idea when you have other motivations going on.
In other words, having pretty clean books if you're headed towards a succession at some point.
Correct. Clean books, and more than that, a good looking revenue and profit.
Right.
And some of these tax, so it's a catch-22. No one wants to pay taxes. But if you want to sell your business for a high multiple, you may have to pay more taxes and report more profit and not be as creative with your tax planning.
And
so that's
that brings up a thought for me, John, which I think is really more of your expertise too, but obviously with Nate. Let's say you want to head towards a succession, and in the idea of a succession, oftentimes we run a lot of, personal items, I guess you could say, or personal business items through our businesses. And there's one thing to have very clean books, but I also think in the small business realm and world, there's an expectation that some people are going to run, different things through their business to a degree. If someone is running things through their business, does it really dramatically hurt them? Or if they keep a very solid schedule or identification or tagging within their GL of what those items are, can those be, managed through conversation or detail or, anything else when you're going through a succession? Does that question make sense?
Yeah, no, those are very common. Almost every business owner has their vehicle paid for, their cell phone paid for, certain travel, other expenses that are in there. When you're looking at a transaction and showing your numbers, to potential buyers, those would be considered what we call discretionary add backs. So if your profit is normally $100,000, but you had $30,000 of this stuff, you would add that 30 back and present your profit as 130, not 100. And that's very well known in the merger acquisition industry. It happens all the time. Everyone understands it, especially in these closely held family type businesses. These types of expenses are flowing through everyone's books. So that is acceptable.
There's also a number of people out here might be looking to grow, and that means acquiring other schools. John, what has been your experience with being able to support due diligence and acquisitions and sort of get through the minutia of what is real and what might not be real?
Yeah, so there's a whole process to that, and we work a lot on merger acquisition. But essentially, you want to make sure that your books and records are in order, just how we started this whole talk. You can't make decisions financially without your books and records in order. So for those of you that think a relative, maybe unless they're an accountant, someone that's not qualified can handle your books, I would call that a mistake. You want to make sure your books and records are in order. Then from there, you can review and perform due diligence. And, when our clients are buying companies, we dig through every account. We look at bank statements. We look at invoices. We look at history. We don't just take their numbers at face value. You have to dig in and make sure you really know what you're buying.
Yeah. Good. And Miriam had asked the question while we were answering that, what does it really mean to run through your business? And I think John started to answer that. So like if you have a personal vehicle, if you have your cell phone that you sometimes use for your business, but you also use for yourself, maybe you had a trip where you're going to a conference, but you also decided to add on to that conference and have your family come and attach a personal vacation to it. Those are things that aren't legitimate business. A portion of them aren't legitimate business expenses, so they get extracted out. Is that a fair way to say it, John?
Yeah, that's fair. Yeah, that's fair. Those are some you mentioned most of the common ones.
Yeah,
The big vehicle is probably the biggest one.
absolutely.
We've also had clients put their kids on the payroll and put them in their marketing materials. That's a creative tax idea we've seen a lot.
I was
It's
just
not a
about to
real
bring that
expense.
up. If you could just talk a little bit about that to make sure no one gets in hot water, but could be very valuable.
Yeah. So first of all, anyone you put on payroll needs to earn the income. So that's where it starts. Then from there, if you choose to put your kids on the payroll, regardless of their age, the most effective way to do that is to put them in your marketing materials on your website, in your brochures, especially in childcare. It's easier to do. So there's, income earned for that. Then what you do is the benefit is you're paying them at their tax rate, which likely could be zero versus maybe your 30 to 40% tax rate. So you're making that savings there. Then you can take those dollars. Now all of a sudden your kids have earned income. And once you have earned income, you can contribute to retirement plans. The most common we see younger people contribute to are Roth IRAs. You also can contribute to college savings plans with that money. So there's an effective way to pay your kids or grandkids and then take those dollars and deposit into 529 college savings plans and or Roth IRAs.
Yeah, and I just saw something about that. Thanks for bringing it up because I did do a little bit of that with my own kids when they were younger and didn't get to the age of 21, and now they no longer help me much. So,
yeah.
But one of the things that I did see recently was if you put $6,000 in for your child who's at 14, by the time he gets retirement, that 6,000 without anything else at pretty much at the S&P 500, income rate, that child would have over $1 million based on that amount. So it is significant. And if you look at what you could do today, that's a tax benefit. It's a write-off for you. And it's a great way to fund an IRA like John just talked about. It's like a slam dunk, but I would definitely do it with a tax professional. Since we're at that point in the conversation, I know you guys do a few different things. So why don't you guys talk about as our financial experts. You've really helped out a lot of people. You've helped out myself tremendously. So why don't you just tell us a little bit about what you guys can help out if anybody's interested in reaching out to us about getting in touch with you guys?
Yeah, I can kind of take you through this slide. So we built what we like to call a financial center because business owners don't, taxes aren't the only item you should be focused on. So we started as a CPA firm that primarily did audits and tax returns. From there, we realized that business owners care more about earning and maintaining wealth than anything else. And that's what they should care the most about. So we put a wealth team together for that. So we could help with retirement planning, estate planning, anything that pertains to growing and maintaining your wealth. We put together an advisory team because outside of taxes, we talked a lot about this already today. If you're looking to expand your company, purchase a business, sell your business, ultimately, we have a whole team that does that. On top of that, we put in place a benefits firm, let's say, that includes employee benefits like healthcare, payroll, outsourced HR, anything in that realm, which is more going to help you along the way to increase your value. And what we've done is we've blended all these services together. So our target client isn't just any business that wants maybe one service, that just wants their tax returns done. We want to work with a motivated business owner that wants help in multiple areas.
Awesome. And we work very close with them. So where like Inspired Care 360 offers a healthcare plan, there are other things such as payroll and outsourcing some HR functionality and the likes that our financial experts here can help with. So Nate, John, thank you so much for what we're going to do is these are the number of things that they can offer. And I want to make sure that you know that if you're interested in getting hold of our friends, Sarah is going to be putting a request into the chat. John, I think there's a couple Q&As that you might want to get to for us
Sure.
out there.
Yeah, we can answer a couple of these live if you want, or do you want me to type them in?
That'd be great. We have a couple minutes left. So
all right. So one question is about, what if I own my building outright under an S corp? Can I pay rent to myself? You can do that, but it's a wash essentially, because what happens is the rent expense that the company pays is a tax deduction, but the rental income to yourself is taxable income, and they offset each other. It really doesn't help you. So the paying the rent early idea is most effective when you have an outside landlord that isn't yourself. The next question, we did talk about that. There was a question about the vehicle deductions, and I answered that in the Q&A. But basically there, it's based on a purchase, not a lease. So if you purchase a vehicle, you can write off the business use percentage of that. That's determined based on mileage. So if you drove your vehicle 90% of the time for business, you can write off 90% of the purchase price of that vehicle. Okay, so if you're buying a $50,000 vehicle, you'd have a $45,000 write-off in that year. You can pay cash or check or whatever for that vehicle outright, but you can even finance it or purchase things on a credit card and still get that deduction. That's considered cash if you're a cash basis taxpayer in the eyes of the IRS.
Great. There's a question here. I purchased my building business under that S corp. I have 11-year loan and pay $6,000 monthly mortgage. I have a CPA. The mortgage is being applied to my personal income. Can I switch the real estate to an LLC to reduce my income?
Yeah, I missed that one. Let's see. Yeah, Mike, 1 second. I just want to read it.
No problem. And we can always get back to after.
Is that in the Q&A or in the chat?
It's in the Q&A. I will
Maybe it might, that one might have just, okay, I got it. I purchased my building business under an S corp. I have an 11-year loan. This is like a question you get in school. I purchased my building business under an S corp. an 11-year loan, pay $6,000 a month mortgage. I have a CPA. The mortgage is being applied to my personal income. Can I switch the real estate to an LLC to reduce my income? Essentially, switching the type of entity doesn't really help. This is, basically your type of entity doesn't make a difference when it comes down to this sort of situation.
Okay.
But
And the
this one,
last,
Jessica probably want to dig in more into your situation and get more information about the question.
yeah, and that is a good opportunity to speak to our financial experts. The last one we have is from April. Do you have to have a family management company established in order to take advantage of putting your child on payroll?
No, your child can be on payroll in your normal child care operating company.
Perfect. Great. Well, we have now gotten to that point where we are at the end of our presentation. I want to thank everybody, especially Nate and John, for participating today. They will both be available for questions after. Again, Sarah has put the link to get a hold of them through us, and we want to get you connected. If you do want to talk to them about this year planning or even thoughts about acquisition, or looking at the fact that you might want to succeed or talk about like safe harbors. Again, our financial experts work very well with other entities. We're not looking just to take over the CPA relationships. A lot of times those will still exist where they come in as consultants. But there are some times where you're like, I do want to make a move, and they have, a pretty deep bench, which is great. So with that said, again, just to review, you can get certificates, and Sarah will put that out there in our links. But we also have a series of ebooks that are on our website if you want to go to it and take a look at it. We also have podcasts, a whole bunch of podcasts that you can download that include these webinars that have been converted to podcasts. So you can listen them to, again, on Spotify or on Apple Play or on all these other areas. You have the ability to review these webinars in your car or the like. So with that said, though, we do have another presentation coming up in the near future, November 8th. Please join us, where we have Grafton Millen, and Grafton is a specialist in child care real estate. And he has written a book on it. He's going to come and talk about the thoughts and process about acquiring real estate as to leases. So it sort of adds on to this a little bit with our financial experts here. So it's a great program. If you could go ahead and look to try to register with that, register early as you can. And this is who we are as Inspired Care 360. So from myself, Tony D'Agostino, with Inspired Care 360, I want to thank Nate again. I want to thank John, our financial expert partners, and everybody. I hope you have a fantastic week. Thank you for your participation, and we'll talk to everybody very soon. Bye now.